Welcome to Talk Tickers. This is the Professionals Earnings Call Summarization Show, where we basically do the heavy lifting for you.
Yeah, we read the transcripts, we crunch the numbers, and we bring you the actual signal through all the noise.
Exactly. And today we have a really fascinating deep dive lined up. We are looking at the Q4 fiscal year 2026 print for Walmart, ticker symbol WMT.
The absolute behemoth of retail.
Right, the behemoth. But what makes this specific deep dive so interesting is that we are going to look at how Walmart is basically executing this massive pivot. They are trying to go from being valued as a low-margin grocer to a high-margin, tech-powered, omni-channel platform.
And somehow, they are actually convincing the market to buy into this tech multiple.
Which is wild. I mean, we are talking about Walmart here. But before we get into the robots and the AI, let's just set the scene for you. This is February 20th, 2026. They dropped these numbers yesterday morning, and the setup here is that the stock had recently hit an all-time high.
Right. It was closing right near that $134 mark.
Yeah, so expectations were they were sky high. And the immediate reaction to the print was a pretty sharp pre-market sell-off. It dropped about 2.8% down to roughly $124 before it kind of stabilized intraday.
It was a textbook sell the news event, or honestly, more of a sell the guidance event.
Exactly. And that is the core thesis we want to explore with you today. The internal execution, the backward-looking numbers, they are screaming growth. But the forward-looking guidance is playing this very deliberate, conservative game to reset expectations for FY27.
Yeah, you read the transcript, and management's tone is very much what I would call cautious but confident.
Right.
When they talk about what they just did in Q4, they are practically taking a victory lap. Execution is great. But when they talk about the future, suddenly they're using words like prudent and unstable backdrop.
Which is classic CFO speak for sandbagging. They are wariness, or they projecting macro wariness, despite the fundamentals like ads and e-commerce just being on fire.
So let's actually look at those headline numbers to see what they're being so confident about.
Yeah, let's do the scorecard. Adjusted EPS came in at 74 cents. That is a penny beat over the consensus of 73 cents.
And GAAP EPS was 53 cents.
Right. And you know, a penny beat sounds like nothing to the average person, but at Walmart scale, a penny represents millions of dollars in operational efficiency.
Oh, absolutely. It's a massive ship to steer. And revenue came in at $190.7 billion.
$190.7 billion in a single quarter. It's just staggering. That beat consensus by about $100 million, and it's up 5.6% year over year.
But the top line revenue isn't even the most exciting part. The real story is the quality of that beat.
Yes, the quality metrics. Because selling a t-shirt or a banana has a terrible margin. But let's look at the other stuff. Global e-commerce was up 24%.
Which is huge for a company of this size.
And global advertising was up 37%, with Walmart Connect, their U.S. ad business, up 41%.
That is the number that steals the show, that ad growth.
It really is. And then you add in membership revenue, which was up 15.1%. So all these high-margin businesses are growing double digits.
Exactly, and that flows right down to profitability. Gross margins expanded by 13 basis points.
13 basis points on $190 billion is a lot of extra cash.
It is a mountain of cash.
Yeah.
Operating cash flow hit $41.6 billion, and free cash flow was right at $14.9 billion.
So the business is structurally getting more profitable. But again, the stock dropped. Investors sold the guidance.
Yep. They saw the volume, I think it was around 43 million shares traded, which is almost 10% above average. People were adjusting their models fast.
They were. But let's get into the deep dive, starting with segment 1. Because this explains why those models might be wrong. The profit engine. This is not just groceries anymore.
No, it's really not. CFO John David Rainey made a very specific point to argue this. He noted that for the third consecutive year, operating income is growing faster than sales.
Right. Operating income was up 10.5%, while sales were up 4.9% in constant currency.
Which is the holy grail for a retailer. Usually as you get bigger, your costs bloat. But they are getting more profitable per dollar of sales.
And it all comes down to the mix shift. The business is shifting toward these higher return streams. The advantage, as we like to call it.
Yeah, global ads up 37%. And we have to remember the Vizio acquisition is now fully in the base numbers.
Yes, the Vizio deal. They mentioned in the Q&A that Vizio advertising actually grew triple digits.
Triple digits.
Yeah.
Which implies Walmart is successfully monetizing its traffic both in-store and online, just like a media network would.
And they gave us this incredible stat. Ad and membership fees now account for nearly 1/3 of their operating income.
1/3. That is a fundamental transformation of the business model.
It is. If a third of your profit comes from subscriptions and ads, you deserve a higher multiple than a traditional supermarket.
Exactly. And those memberships are so sticky. You mentioned fees were up 15.1% globally. Sam's Club China was up 35% alone.
And Walmart Plus is seeing double-digit growth in the US, too. It creates this recurring revenue floor that pure-play retailers just do not have.
Right, it protects them. If foot traffic dips because of a snowstorm, they still collected your Walmart Plus fee for the month.
Which is a perfect segue into segment 2, the bifurcated consumer, because we really have a tale of two wallets happening here.
We do. And CEO John Furner had a really telling statistic about the wealthy shopper.
Yeah, he said the majority of their market share gains are actually coming from households earning over $100,000 a year.
Which used to be the core demographic for specialty stores or higher-end grocers. But they are coming to Walmart now.
And they're coming for convenience. Management noted that fast delivery, which they define as under 3 hours, grew by 60%.
60% growth in fast delivery. That wealthy demographic isn't clipping coupons in the aisle. They are sitting on their couch, ordering a mix of groceries and maybe a new coffee maker, and having it dropped at their door in 2 hours.
Right, because fashion and general merchandise sales are actually up mid-single digits. This proves the wealthy shoppers aren't just making quick grocery runs, they are buying higher margin items too.
But then you have to look at the other side of the spectrum, the stretched shopper.
Yeah, the households earning under $50,000. Management was very clear that this group is managing paycheck to paycheck right now.
They even noted some early Q4 weakness, specifically tied to shifts in government shutdown benefits.
Exactly. When a slight delay in a government benefit program causes a noticeable dip in Walmart's massive revenue stream, you know the consumer is incredibly fragile.
It really highlights how Walmart acts as a defensive hedge in the market.
Totally. They capture that trade-down consumer because they have the lowest prices, but they are also capturing the trade-up consumer because they have the best convenience and tech.
It's a win-win for their market share. Which brings us to the tech itself, which is honestly the most mind-blowing part of this print. Segment 3. The Sparky factor.
Sparky! I love that they named their AI shopping assistant Sparky.
It's a friendly name for a very powerful tool.
It is. So for those who don't know, Sparky is Walmart's generative AI assistant built right into the app. And the adoption numbers are crazy. Roughly half of their app users have already engaged with it.
Getting 50% of your user base to adopt a new AI feature is unheard of. Usually these things are just buried in a menu somewhere.
Yeah, but they put it front and center. And the killer stat, the one that proves this entire tech thesis, is the average order value.
Right. Sparky users have an average order value that is 35% higher than non-Sparky users.
35%. Just by using an AI assistant, a customer is putting 35% more value into their digital cart.
It's because they are moving toward what we call agentic commerce.
Let's explain that for you guys because it's a huge shift. Agentic commerce basically means moving from a search-based model to an intent-based model.
Exactly. In the past, if you wanted to plan a birthday party, you had to search for balloons, add to cart, then search for a cake, add to cart, then plates.
It's tedious. But with agentic commerce, you just open the app and say, plan a birthday party for my 8-year-old.
And Sparky understands the intent. It builds the whole basket for you. It suggests the cake, the candles, the decorations, maybe a gift.
And you just hit approve. That lack of friction is what drives the 35% basket expansion. You buy the things you would have forgotten.
And the massive strategic advantage here is that Walmart actually has the physical nodes to fulfill that AI's plan.
Right. ChatGPT can plan a party for you, but it can't deliver the balloons. Walmart has the stores and the distribution centers to execute that intent immediately.
This is genuinely the holy grail of retail. Using AI tech to force basket expansion without having to rely on heavy discounting.
It is brilliant, but obviously you need a flawless supply chain to make that happen. Which leads us to segment 4, operational excellence.
Because none of that AI stuff matters if you don't have the inventory discipline to back it up.
Exactly. And their inventory numbers were incredibly tight. Inventory was up only 2.6%, while sales grew roughly 5%.
That shows extreme discipline. They are turning over their stock faster. Management made a big point about being quote-unquote clean on inventory entering this new year.
Being clean on inventory means no massive markdowns to clear out dead stock, and a lot of this efficiency is coming from automation.
Yeah, the heavy CapEx cycle they went through is finally paying off. They said that about 60% of their stores now receive freight from automated distribution centers.
60%. And on the digital side, 50% of their e-commerce fulfillment volume is now fully automated.
which directly led to the SG&A leverage they achieved in Q4. Their overhead costs grew slower than their revenue because the robots are doing the heavy lifting.
It's the inflection point we've been waiting for, and it enables these insane delivery speeds. 35% of their store-fulfilled orders are delivered in under 3 hours now.
And look internationally. Flipkart in India is doing sub-15-minute deliveries across 30 cities.
Under 15 minutes. By the time you realize you are out of milk, it's already on your porch.
Right.
They are successfully competing with Amazon on speed by using their physical stores as forward deployment nodes.
It's a massive moat. Amazon has warehouses, but Walmart has 4,600 stores sitting right inside the neighborhoods.
Okay, so we've established they have AI driving massive baskets, they have a highly automated supply chain, and they have wealthy consumers flocking to them. So why was the guidance so weak? Let's get into segment 5, the sandbagged guidance.
Yeah, the numbers they put out for FY27 definitely spook the market at first glance.
The full-year EPS guide was $2.75 to $2.85, and they projected sales growth of only 3.5 to 4.5%.
And the Q1 guide was particularly soft. They called for EPS of 63 to 65 cents and explicitly said operating income growth would be at its lowest point in Q1.
Because of timing and tariffs, right. They cited tariffs as creating a very bumpy environment.
Tariffs are the easy scapegoat right now, but they are a real headwind for importers. They also mentioned the maximum fair pricing legislation on drugs.
Yeah, that's expected to be a full 100 basis point headwind for the year. That is a significant drag on the pharmacy side of the business.
Plus the general macro uncertainty. They flagged hiring recession risks and student loan delinquencies weighing on that lower income shopper.
And this is the crucial part. CFO John David Rainey explicitly told everyone on the call that they are starting with conservatism.
He essentially reminded Wall Street that Walmart has a long history of raising guidance as the year progresses.
It is a strategic reset. They know the stock was priced for absolute perfection. So you lower the bar now, you take a small hit on the chin, and then you set yourself up for an easy beat and raise narrative for the next 4 quarters.
It's smart management. And they gave investors a massive cushion to absorb that lower guidance in segment 6, which is capital allocation.
The bull case kicker. They authorized a brand new $30 billion share repurchase program.
$30 billion, that is the largest buyback authorization in the company's entire history.
And they bumped the dividend up to 99 cents a share.
This is how you put a floor under a stock price. Even if your top-line growth slows down slightly, aggressively reducing the share count through buybacks is going to support that EPS number artificially.
Exactly. It tells the market, hey, we have so much free cash flow, we can buy our own stock if you guys don't want it.
All right, let's jump into segment 7, the Q&A lightning round. There were some really interesting nuggets pulled from the analyst questions.
The first one we have to talk about is GLP-1 drugs. Everyone thinks Ozempic is going to destroy food retail.
But management said the impact for them is completely neutral.
Which makes sense when you hear their logic. They pointed out that fresh food is actually a huge basket driver.
Right. People on GLP-1 still eat, they just eat healthier. They buy fresh produce and lean meats. And shoppers who buy fresh food tend to buy a lot of other high-margin items while they are in the store.
So they aren't worried at all. Another thing that came up was tax refunds.
Yeah, their guidance actually assumes an increase in tax refunds this year, which acts as a macro tailwind for that stretched consumer demographic.
It puts a little extra cash in the pockets of the people who need it most right when Q1 is ending. And lastly, on the Q&A, they talked about marketplace profitability.
They admitted it is still very much in investment mode. It is not profitable yet.
But the growth is there. Categories like home and fashion on the third-party marketplace are growing over 40%. They are grabbing land right now. They'll worry about extracting rent later.
So bringing this all together for some investor context, the overall narrative shift here is profound.
It really is. You cannot look at Walmart as just a defensive consumer staples play anymore. They are a tech-enabled ecosystem.
And the market is starting to price that in. If you look at the 52-week performance, WMT is up about 25%, while the broader consumer staples ETF, the XLP, is only up about 8%.
They are completely detaching from their traditional peers, and the pullback from the all-time high just lets the valuation catch its breath against this conservative guidance.
Because the flywheel is clearly spinning faster than ever.
Right. Let's trace the flywheel for you. E-commerce growth leads to more digital traffic. That traffic lets them sell more ads.
Those ads generate incredibly high margins.
They take those fat margins and reinvest them into lowering prices and speeding up delivery.
Which wins them more market share. specifically from wealthy consumers, which drives more e-commerce growth.
And the cycle repeats. It is a beautiful machine.
Okay, I think it is time for our favorite part of the show.
Yes, it is. This is not financial advice segment.
Please remember, we are just two people doing a deep dive. This is for entertainment purposes only. Do your own research. Do not trade based solely on our wild ideas.
Seriously, don't sue us. But having said that, I do have a trade pitch for you based on this specific earnings print. I call it the long-short class warfare arb.
Or the robot butler levered long.
I like both titles. Here is the insight driving this trade. That 35% higher basket size for AI users is, in my opinion, the most important number in the entire transcript.
Because it signals a fundamental shift in unit economics.
Exactly. The market hasn't fully priced it in because it was buried in all this tech beta talk. But I think the 3.5% revenue guidance is a flat-out lie.
You think they're going to blow past it?
If Sparky adoption moves from 50% of users up to 75%, and that massive 35% basket lift holds steady, their top line is going to explode.
So the trade is to go long on Walmart.
Specifically, deep out-of-the-money LPs. You buy long-term options betting that the conservative guidance is a sandbag and they will beat and raise all year.
Okay, but what is the short side of this arb?
The outrageous twist is that you pair those Walmart LPs by shorting a pure play dollar store. Think of a Dollar General or a Family Dollar equivalent.
Oh, that is brutal. But the logic tracks.
It perfectly tracks the bifurcated consumer data we just talked about. The over 100K consumer is flocking to Walmart for the AI tech and the fast delivery.
While the under 50K consumer, which is the core dollar store demographic, is completely stretched.
Right. And Walmart uses its massive ad profits to suppress prices on staple goods, which completely squeezes the dollar stores out of the market. They can't compete on price anymore.
So you are basically playing the widening gap between the AI shopper and the paycheck shopper.
Yes. You go long on the company winning the rich with robots and short the companies struggling to sell cheap goods to the poor. It's the class warfare arb.
It is cynical, but it is a highly plausible interpretation of the data they just gave us.
Well, the numbers tell the story. Let's wrap this up with a quick conclusion.
To recap, Walmart delivered a very strong beat. E-commerce and advertising are firing on all cylinders.
The guidance looks soft, but it's highly likely they're just sandbagging to set up an easy year.
And that massive $30 billion buyback gives investors a huge safety net underneath the current valuation.
So our final thought for you to chew on is this. Walmart is proving that in 2026, the biggest physical retailer in the world is actually just a data company in disguise.
Keep your eyes on that advertising line item. It is a true proxy for their future profitability.
Well said. Thank you all for joining us on this deep dive. Keep your eyes on the tape, and we will catch you next time.
Take care, everyone.